Before we begin, please remember that I am not a financial advisor, and this presentation is for educational and informational purposes only. The content of this video should not be considered financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified professional before making any investment decisions. You've decided to do the right thing. You're putting money away for your future, for retirement, for your kids' college. You log into your 401k or your brokerage account, ready to invest, and you're hit with the wall. A massive, overwhelming wall of cryptic names and ticker symbols. The American Century Ultra Fund, the Fidelity Contra Fund, the T. Rowe Price Blue Chip Growth Fund. There are over 7,000 mutual funds in the United States alone. That's more options than there are stocks on the New York Stock Exchange and the NASDAQ combined. It feels like trying to find one specific person in a sold-out Super Bowl stadium, and you've been told that person holds the keys to your financial freedom. What do most of us do? We freeze. We get analysis paralysis. So we either make a random guess based on a familiar name, or worse, we just leave our hard-earned money sitting in a default money market account, getting eaten alive by inflation. There is a fundamental, costly mistake that millions of Americans are making right now, and it has nothing to do with timing the market or picking hot stocks. It's that they are evaluating these funds with the wrong tools. They're looking at the wrong numbers. Most people look at one thing and one thing only: past performance. They see a fund that went up 20% last year and they think, that's the one. But here's the brutal truth the financial industry doesn't want you to know. Relying on past performance to pick a mutual fund is like trying to drive a car down the highway by looking only in the rearview mirror. It tells you where you've been, but it gives you almost zero predictive power about the road ahead. This video is going to change that. Over the next several parts, I am going to give you a complete, battle-tested framework for analyzing mutual funds like a seasoned professional. I'm going to hand you a diagnostic toolkit that will allow you to cut through the noise, ignore the marketing hype, and identify the small handful of elite funds that are truly built for long-term success. You will learn to spot the red flags that scream stay away, and to recognize the green lights that signal a high-quality investment. By the time we're done, you will never again feel that sense of overwhelm. You will have a repeatable system, a checklist that gives you the clarity and confidence to build a powerful, low-cost, and high-performing portfolio for your future. So, let's get started with the single most important metric. The one number that has more predictive power over your future returns than any other. It's not glamorous. It's not exciting. In fact, it's designed to be boring and hidden in the fine print. I'm talking about the expense ratio. Think of the expense ratio as the silent killer of your wealth. It's a tiny, almost invisible leak in your financial boat. On its own, one little drip doesn't seem like a big deal. But over the course of a long journey, those drips compound, and you can find yourself taking on an enormous amount of water, slowing you down and threatening to sink the whole ship. The expense ratio is the annual fee that the fund company charges to manage your money, expressed as a percentage of your investment. So, an expense ratio of 1% means that for every $10,000 you have invested, you are paying the fund company $100 per year, every single year, whether the fund makes money or loses money. 1%. You might be thinking, that sounds tiny. What's the big deal? This is the trap. This is the cognitive bias that costs investors fortunes. Let's run the numbers and see the devastating impact of that seemingly small fee over time. Let's imagine two people, Sarah and Tom. Both start with $10,000 to invest, and both plan to leave it invested for 30 years. Both of their chosen funds earn an average annual return of 8% before fees. The only difference is the expense ratio. Sarah, being a savvy investor, chooses a low-cost index fund with an expense ratio of just 0.05%. Tom, on the other hand, invests in a popular, actively managed fund his bank recommended, which has an expense ratio of 1%. Again, just a 0.95% difference. Seems trivial. After 30 years, Sarah's $10,000, earning 7.95% per year after fees, has grown to over $99,000. A fantastic result. Now let's look at Tom. His $10,000, earning only 7% per year after that 1% fee is skimmed off the top, has grown to just over $76,000. Let me say that again. That tiny less than 1% difference in the annual fee has cost Tom over $23,000. He has lost nearly a quarter of his potential nest egg to fees. That money didn't just vanish. It was transferred directly from his retirement account into the pockets of the fund company. Now, imagine this effect scaled up over a lifetime of saving and investing hundreds of thousands of dollars. The difference isn't $23,000. It's hundreds of thousands, or even millions of dollars in lost wealth. The expense ratio is the single greatest friction point on the compounding machine. Your job as an investor is to minimize that friction at all costs. So what's a good number? For a broad market index fund like one that tracks the S&P 500, you should be looking for an expense ratio of 0.1% or less. Many of the best ones are now under 0.05%. It's an incredibly competitive space, which is great news for you. For an actively managed fund, where a manager is supposedly picking stocks to beat the market, you will pay more. But even here, you should be deeply skeptical of any fund charging over 1%. A reasonable range for a quality active fund might be between 0.5% and 0.8%. Anything higher, and the manager has to be a legitimate superstar just to overcome the headwind of their own fees. Now, I can hear the objection already. But wait, don't you get what you pay for? A higher fee must mean you're getting a brilliant manager, a better research team, and ultimately better performance, right? It's a logical assumption. It's how the world works for cars, for houses, for almost everything we buy. But in the world of investing, it is a catastrophic and demonstrably false belief. Study after study, most notably the recurring SPIVA report from S&P Dow Jones Indices, shows the exact opposite to be true. Over any meaningful long-term period, 10, 15, 20 years, the overwhelming majority of high-cost, actively managed funds fail to outperform their low-cost benchmark index. In fact, after fees are accounted for, over 90% of them underperform. You are paying a premium price for a product that is statistically likely to give you a worse result. It's like paying for a first-class ticket and being forced to sit in the cargo hold. The expense ratio is your first and most powerful filter. Before you look at anything else, before you look at the fund's holdings, its strategy, or its star rating, you look at the price tag. If the price is too high, it doesn't matter how great the product is supposed to be. The math is already working against you. You can find this number easily. It's listed on any fund screener, on Yahoo Finance, or in the fund's official prospectus document. Make checking it your first non-negotiable step. But the expense ratio is just the beginning. It tells you the price you're paying, but it doesn't tell you anything about what you're actually buying. It doesn't tell you how well the fund is actually managed, or how much risk the manager is taking to get their returns. To understand that, we have to move beyond the price tag and start looking under the hood at the engine itself. And that brings us to our second critical metric, a concept that separates amateur investors from the pros, and it has to do with something called turnover. So what is turnover? Imagine the mutual fund isn't a car, but a professional basketball team. The stocks, the Apples, the Amazons, the Johnson & Johnsons are the players on the court. And the fund manager? That's your head coach. Their job is to build a championship-winning team that will make you, the owner, a lot of money over the long haul. Now, a low-turnover coach is like Greg Popovich of the San Antonio Spurs. He identifies incredible talent, he brings them onto the team, and he sticks with them. He builds a system around his star players. He believes in their long-term potential, even when they have a bad game or a tough week. He's not trading his star player every time a shinier, newer rookie has a hot streak. He has conviction. The result is a dynasty built on stability and a clear, consistent philosophy. A high-turnover coach, on the other hand, is in a constant state of panic. They're a frantic day trader in a suit. They sign a hotshot player, and if he doesn't score 40 points in his first 2 games, they trade him for someone else. They're constantly shuffling the roster, chasing headlines, reacting to every bit of news, trying to guess who's going to be hot next week. The team has no chemistry, no core identity. It's just a revolving door of players. The turnover ratio of a mutual fund is the financial equivalent of this coaching style. It's a percentage that tells you how much of the fund's portfolio, how many of its players, have been replaced over the past year. A turnover ratio of 100% means the manager has, in effect, sold and replaced every single stock in the fund within 12 months. It's a completely new team. A turnover ratio of 20% means only 1/5 of the portfolio has been changed. That's a team built on stability and long-term conviction. Now you might be thinking, okay, but who cares? If the coach is winning games, what does it matter how often he trades players? And that is the multi-trillion-dollar question. Because in the world of investing, unlike in basketball, every single trade comes with a hidden cost. And you, the investor, are the one who pays the bill. There are two massive, wealth-destroying costs associated with high turnover. The first one is simple trading costs. Every time your fund manager buys or sells a stock, the fund has to pay a commission, a brokerage fee. It might be a fraction of a penny per share, but when you're dealing with hundreds of millions or even billions of dollars, those pennies add up to a mountain of cash. And where does that money come from? Comes directly out of your returns. It's a direct, measurable drag on the fund's performance. A fund with a 100% turnover rate is essentially paying double the trading fees of a fund with 50% turnover, all other things being equal. It's like your frantic coach is trading players left and right and sending you the bill for the agent fees and the paperwork. The more they trade, the more you pay. But that's not even the worst part. The second hidden cost is far more sinister, and it's the one that truly separates the pros from the amateurs. That cost is taxes. This is critical. When your fund manager sells a stock for a profit, that's called a capital gain. By law, the mutual fund can't just keep that profit. At the end of the year, it has to distribute those capital gains to its shareholders. And who is the shareholder? You are. And when you receive that distribution, you have to pay taxes on it. Let me say that again because it's so important and so widely misunderstood. Even if you never sold a single share of your mutual fund, if the manager inside the fund is selling stocks for a profit, you will get a tax bill for their actions. Imagine you own a fund that goes up 10% in a year. You're thrilled. You haven't sold anything, you're just letting your money grow. But your manager has a 150% turnover ratio. He was buying and selling like a madman all year, locking in gains along the way. Come January, you get a form in the mail called a 1099 DIV, and it says you owe taxes on thousands of dollars in capital gains distributions. You're confused. You think, but I didn't sell anything. I'm a long-term investor. It doesn't matter. Your manager sold, so you pay. This is a catastrophic drain on your wealth. It's called tax drag. A high turnover fund is a tax inefficient machine. It's constantly forcing you to give a chunk of your profits to the IRS, money that could have stayed invested and been compounding for you for decades to come. A low turnover fund, by contrast, is far more tax efficient. By holding on to winning stocks for years, the manager defers those capital gains, and therefore defers your tax bill, allowing your money to grow uninterrupted. It's the single biggest advantage of a long-term buy and hold strategy. So, when you see a high turnover ratio, you're not just seeing a number. You're getting a direct window into the fund manager's soul. You're learning about their philosophy. A high turnover, say above 80 or 100%, suggests the manager is a market timer. They believe they can predict the short-term zigs and zags of the market. They're a speculator, not an investor. They're playing a game that almost no one, not even the most brilliant minds on Wall Street, has ever won consistently over time. A low turnover ratio, let's say under 30%, tells a completely different story. It signals patience. It signals discipline. It suggests the manager isn't buying stocks. They're buying businesses. They've done deep fundamental research on a company, its management, its competitive advantages, and they believe in its value over the next 5, 10, or 20 years. They have the confidence to hold on through market volatility because their conviction is based on the business, not its fluctuating daily stock price. This is the mindset of Warren Buffett, whose favorite holding period is forever. That philosophy is the bedrock of low turnover. So what are the numbers you should actually look for? Generally speaking, for a standard stock fund, anything under 20% is exceptionally low and signals a true buy and hold disciple. A ratio between 20% and 50% is still considered low and indicates a manager with a long-term focus. Once you start creeping above 70% and especially over 100%, red flags should be going up. You need to ask yourself, is this manager's performance so spectacular that it can overcome the built-in headwinds of higher trading costs and a massive tax drag? The answer is almost always no. Now, are there exceptions? Of course. Some specific strategies, like certain quantitative funds that use algorithms to trade, will naturally have high turnover. But for the vast majority of investors looking to build long-term wealth in a standard equity fund, turnover is a hidden killer. It's a subtle but relentless fee that eats away at your returns year after year. Looking at the expense ratio, our first metric, is like checking the sticker price of the car. It's important, but it's just the beginning. Analyzing the turnover ratio is like asking the dealer to pop the hood and then checking the car's maintenance records. Tells you how the previous owner drove it. Did they drive it carefully with a long-term vision, maintaining it for the road ahead? Or did they redline it every single day, burning through parts, creating constant wear and tear, leaving you with a hidden repair bill that will cost you a fortune down the line? So now we know how to check the price tag, and we know how to spot the hidden costs and frantic, costly trading that can doom a fund from the inside out. But what about the actual performance? Everyone looks at the one-year return, but that's a rookie mistake. Tells you almost nothing. The real story, the one that tells you if a fund manager is truly skilled or just got lucky one time in a bull market, is hidden in a different set of numbers. And that brings us to our third metric, understanding risk-adjusted returns. Think of it like this. You have two surgeons. Surgeon A has a 95% success rate, but her patients often have major complications, long recovery times, and she's known for taking wild, unnecessary risks in the operating room. Surgeon B has a 93% success rate, but her procedures are textbook. Clean, efficient, with minimal complications and fast recovery times. On paper, based on one simple number, Surgeon A looks slightly better. But who would you rather have operating on you? Who is the truly more skilled professional? The answer is obvious. It's the one who gets great results without putting you through hell to get there. That is the essence of risk-adjusted returns. It's not just about how much money a fund made. It's about how much turbulence, how much gut-wrenching volatility, how many sleepless nights you had to endure to get that return. A fund that gains 25% by betting the farm on some obscure, volatile tech stock is not necessarily better than a fund that gains a steady, reliable 15% by investing in high-quality, stable companies. The first one took a massive gamble. The second one executed a brilliant strategy. And the tools we use to tell the difference are called risk-adjusted return metrics. The most famous, the one you absolutely must know, is the Sharpe ratio. The Sharpe ratio is the undisputed heavyweight champion of risk metrics. If you only learn one, make it this one. What it does is brilliant in its simplicity. It asks a very simple question. For every unit of risk I took, how much reward did I get back above what I could have gotten risk-free? Let's break that down. First, it takes the fund's total return. Then it subtracts something called the risk-free rate. This is basically the return you could get by taking zero risk. Think of a US Treasury bill. It's the baseline. The result is the fund's excess return, the money it made on top of the guaranteed thing. Then the magic happens. It divides that excess return by the fund's standard deviation. Now, standard deviation is just a fancy term for how bumpy the ride was. A high standard deviation means the fund's price was all over the place. Up 10% one month, down 15% the next. A low standard deviation means a smooth, steady climb. So, the Sharpe ratio literally gives you a score for how much excess return you got for each unit of bumpiness. A higher Sharpe ratio is always better. It means you're getting more bang for your risk buck. Let's use an example. Fund Alpha returned 20% last year. Sounds amazing, right? But its standard deviation was also 20%. It was a white-knuckle roller coaster. The risk-free rate was 3%. So its excess return was 17%. 20 minus 3. You divide that 17% by its 20% standard deviation, and you get a Sharpe ratio of 0.85. Not bad. Now look at Fund Bravo. It only returned 12%. Seems less impressive, but its standard deviation was a tiny 6%. A much smoother ride. Let's do the math. Its excess return is 9%. 12 minus 3. Divide that 9% by its 6% standard deviation, and you get a Sharpe ratio of 1.5. Look at that. Fund Bravo, with a much lower headline return, is the vastly superior investment from a risk-adjusted perspective. Its manager generated a much more efficient return. They didn't just get lucky on a wild bet. They skillfully navigated the market to deliver strong returns without giving their investors a heart attack. Generally speaking, a Sharpe ratio above 1 is considered good. Above 2 is very good, and above 3 is elite. A negative Sharpe ratio means you took on risk and still did worse than a risk-free T-bill, which is a catastrophic failure. But the Sharpe ratio has one major flaw. It treats all volatility as bad. It punishes a fund for a sudden 15% drop the exact same way it punishes a fund for a sudden 15% gain. Think about that. As an investor, do you complain when your fund skyrockets? Of course not. That's not risk, that's opportunity. The only volatility you truly care about is the downside, the risk of losing money. And that's where the Sharpe ratio's smarter, more sophisticated cousin comes in. The Sortino ratio. The Sortino ratio is a game changer because it redefines risk. It says, we're only going to measure the bad volatility. It ignores all the upward price swings, the good volatility, and focuses solely on the standard deviation of the negative returns. It only looks at the times the fund loss value. It then takes the fund's excess return and divides it by this downside-only deviation. This gives you a much more practical, real-world picture of a fund's performance. It answers the question investors are really asking. For every unit of bad risk I took, the risk of my investment going down, how much excess return did I get? Imagine two funds that both end the year up 15% and have the same overall volatility, so their Sharpe ratios are identical. But Fund X got there with a series of small gains and a few massive soaring upward spikes. Fund Y got there with a steady climb punctuated by several terrifying, sharp nosedives before recovering. The Sharpe ratio sees them as equal, but the Sortino ratio would immediately identify Fund Y as the riskier, less desirable fund. It would have a much lower Sortino ratio because it penalizes that harmful downside volatility while giving Fund X a pass for its harmless, and in fact wonderful upside volatility. For any investor who is more concerned with capital preservation than with shooting for the moon, the Sortino ratio is an infinitely more useful metric. A higher Sortino ratio means the fund is better at protecting you on the downside, while still generating returns. Now there's one more key player in this family of metrics, and it's for the investor who thinks like a portfolio architect. It's called the Trainer ratio. To understand the Trainer ratio, you first have to understand a little concept called beta. Beta measures a fund's volatility in relation to the overall market, which is usually represented by an index like the S&P 500. The market itself has a beta of 1. A fund with a beta of 1.2 is theoretically 20% more volatile than the market. If the S&P 500 goes up 10%, this fund might go up 12%. But if the market drops 10%, it could drop 12%. A fund with a beta of 0.8 is 20% less volatile than the market. It's more defensive. The Trainer ratio is structured just like the Sharpe ratio. It takes the fund's excess return over the risk-free rate. But instead of dividing by total volatility, standard deviation, it divides by the fund's beta. So what does this tell us? It tells us how much excess return you're getting for each unit of market risk you're taking on. This is a subtle but crucial distinction. Standard deviation measures total risk, risk from the market, from the specific industry, from the individual companies, everything. Beta only measures systematic risk, the kind of risk inherent to being in the market that you can't get rid of through diversification. The Trainer ratio is most useful when you're building a diversified portfolio. If you already own a bunch of different assets, the unique, quirky risks of a single new fund don't matter as much because they'll be balanced out by everything else you own. What you really care about is how much market-level risk this new fund is adding to your overall mix. The Trainer ratio helps you compare funds on that specific basis. So, to recap this critical lesson, when you're looking at a fund, don't just stop at the 1, 3, and 5-year returns. Go to the Risk tab on Morningstar or Yahoo Finance. You don't have to calculate a thing. Just look. Use the Sharpe ratio for a great all-around measure of risk-adjusted performance. It's your go-to metric. Use the Sortino ratio if you're a more conservative investor who hates losing money and wants to see which manager is best at protecting the downside. And use the Trainer ratio when you're comparing funds to add to an already well-diversified portfolio to see which one gives you the most return for the market risk it adds. By comparing these three numbers between funds, you move from being a novice who just chases past returns to a sophisticated investor who understands the quality of those returns. You can finally see past the marketing hype and identify the managers who are truly skilled, not just lucky. But even a fund with a stellar Sharpe ratio can hide a ticking time bomb. These numbers, as powerful as they are, tell you what happened. They don't always tell you why it happened, or if it's likely to happen again. To find that out, you have to pop the hood. You have to dissect the fund's DNA and see what it's actually made of. And that brings us to our next crucial step: analyzing a fund's holdings and sector allocation. Think of a mutual fund like a gourmet meal prepared by a world-class chef. The fund's name, say the Global Growth Fund, is just the name of the dish on the menu. It sounds appealing, but it tells you almost nothing about the actual ingredients. Is it spicy? Is it vegetarian? Does it contain nuts you might be allergic to? To know that, you need to see the recipe. That's exactly what analyzing holdings and sector allocation is. Looking at the fund's recipe. It's the single most important step to understanding what you are actually buying and the risks you are taking on. Let's start with the most obvious part of the recipe: the top 10 holdings. Every fund is required to disclose its largest positions. This is your first and most powerful glimpse into the fund manager's mind. These aren't just random stocks. These are the manager's highest conviction ideas. These are the companies they are betting the farm on. If a fund manager has put 5, 6, or even 10% of the entire fund's assets into a single company, they are making a massive statement. They are telling you, I believe in this company more than almost any other. When you look at that list, ask yourself a few questions. First, do you recognize these names? Are they the usual suspects, Apple, Microsoft, Amazon, or are they companies you've never heard of? There's no right or wrong answer, but it tells you about the manager's style. Are they sticking to the well-trodden path of megacap giants? Or are they venturing into undiscovered territory? Second, and this is crucial, look at the concentration. What percentage of the fund's total assets is tied up in these top 10 stocks? You'll see this listed right next to the holdings. Some funds might have 60% of their money in just 10 companies. That is a highly concentrated, high-stakes strategy. It's like a basketball team where one superstar takes almost all the shots. If that player is on fire, you're going to win big. But if they have an off night, the whole team suffers. On the other hand, you might see a fund with only 15% in its top 10. That fund is far more diversified. It's like a team with a deep bench, spreading the scoring around. Its performance doesn't live or die by the fate of one or two companies. Again, one isn't inherently better than the other, but they represent wildly different risk profiles. A concentrated fund offers the potential for explosive growth, but also for gut-wrenching volatility. A diversified fund will likely offer a smoother ride, but might not capture the same lightning in a bottle. You have to decide which strategy aligns with your own stomach for risk. But looking at a single fund's holdings in a vacuum is only half the story. The real pro-level analysis comes when you compare a fund's holdings to the other funds you already own. This is where most investors make a catastrophic, yet completely avoidable mistake. It's a phenomenon I call accidental concentration, or diversification. It goes like this. You decide you want to be a smart, diversified investor. So you buy a large-cap growth fund. Then you add a technology sector fund to get more exposure to innovation. Then you buy an S&P 500 index fund for broad market exposure. You feel great. You look at your portfolio and see 3 different fund names. You feel protected, diversified, safe. But when you pop the hood on all 3, what do you find? The top holdings of the large cap growth fund are Apple, Microsoft, Nvidia, and Amazon. The top holdings of the tech fund are Apple, Microsoft, Nvidia, and Amazon. And the biggest companies in the S&P 500 index fund are, guess what? Apple, Microsoft, Nvidia, and Amazon. You haven't diversified at all. You've done the opposite. You've inadvertently tripled down on the exact same handful of companies. You haven't built a balanced portfolio. You've built a shrine to big tech. All you've really done is pay 3 different sets of fees to own the same stuff. This is the silent portfolio killer. Your risk is far more concentrated than you think. And if that handful of stocks takes a nosedive, your entire diversified portfolio goes down with it. So before you ever buy a new fund, you must check its top holdings against your existing investments. Are you truly adding something new to the mix? Or are you just buying more of what you already have? Now let's zoom out from the individual ingredients, the stocks, to the food groups. This is sector allocation. It tells you how the fund's money is divided across the major segments of the economy: information technology, healthcare, financials, consumer discretionary, industrials, and so on. Why does this matter so much? Because a fund's performance is often driven more by its sector bets than its individual stock picks. If a fund manager decided to pour 40% of their fund into technology stocks at the beginning of the last decade, they looked like a genius. They didn't have to pick the absolute best tech stocks, they just had to be on the right ship. The rising tide of the entire sector lifted their boat. Conversely, a manager who was overweight in energy stocks during that same period probably had a miserable time, no matter how well run their chosen companies were. Looking at sector allocation protects you from misleading fund names. You might buy a U.S. opportunity fund, thinking you're getting a broad slice of the American economy. But when you look at the sector breakdown, you discover it has 50% in financials and 30% in industrials. It's not a broad fund at all. It's a massive concentrated bet on 2 specific corners of the market. And its fate will be tied to the health of those 2 sectors. This isn't necessarily bad, but you absolutely need to know it before you invest. You need to know if the dish you ordered, the U.S. opportunity, is actually a giant plate of bank and factory stocks. Going one level deeper, understanding sector allocation helps you understand how a fund is likely to behave in different economic environments. We can broadly group sectors into two categories: cyclical and defensive. Cyclical sectors are like a convertible sports car. They are a ton of fun when the sun is shining and the economy is booming. These are sectors like consumer discretionary, think restaurants, luxury cars and vacations, or industrials, which thrive when companies are building and expanding. When people have jobs and feel confident, they spend money and these sectors soar. But when a recession hits and people start tightening their belts, these are the first sectors to get hammered. Defensive sectors, on the other hand, are like a reliable, all-wheel drive SUV. They might not be as flashy, but they get you through the storm. These are sectors like consumer staples, companies that sell toothpaste, toilet paper and groceries, or utilities and healthcare. No matter how bad the economy gets, people still need to brush their teeth, keep the lights on and go to the doctor. These companies have steady, predictable demand, which makes them a relative safe haven during economic downturns. By looking at a fund's sector breakdown, you can instantly diagnose its personality. Is it a high-octane cyclical fund built for bull markets? Or is it a steady defensive fund designed to weather a recession? A fund heavily weighted in tech and consumer discretionary is flooring the gas pedal. A fund focused on utilities and consumer staples is prioritizing safety and stability. Knowing this mix helps you build a truly balanced portfolio. One that has engines for growth, but also shock absorbers for the inevitable bumps in the road. So, when you put it all together, you move from a blurry black and white photo of a fund to a high-definition 4K picture. You don't just see the fund's name, you see its top 10 highest conviction bets. You see how concentrated or diversified those bets are. You see how it overlaps or doesn't with your other investments. And you see its broad strategic tilt, whether it's betting on a tech boom or bracing for a financial winter. You understand the fund's DNA. You know the recipe. You know exactly what you are buying. Now, once you've done this analysis and found a fund with a strategy you believe in, with holdings that make sense, and a sector allocation that fits your goals, it's easy to think the work is done. But there's a hidden force working against you every single day you own a fund. It's a silent drain on your performance, a constant tax on your returns that can turn a great investment into a merely good one over time. It's the one thing that can devour tens, or even hundreds of thousands of dollars from your retirement nest egg without you ever noticing. And that is the cost of the fund itself. It's the silent killer of wealth. A tiny percentage, a seemingly insignificant number buried deep in a prospectus, that works against you day after day, year after year. Think of it like a boat with a very small, almost invisible hole. On a short trip, you might not even notice the water seeping in. But on a long voyage across the ocean, the voyage to your retirement, that tiny hole can be the difference between reaching your destination with a ship full of treasure, or arriving with a waterlogged vessel, or even sinking entirely. This cost is officially known as the expense ratio, and it is, without a doubt, the single most important metric you can look at. In fact, extensive research from firms like Morningstar has shown that the expense ratio is a more reliable predictor of a fund's future success than its past performance. Let that sink in. A low cost is a better indicator of future returns than a 5-star rating. Why? Because past performance is a story about what happened. The expense ratio is a mathematical certainty about what will happen. It's a guaranteed headwind you have to overcome every single year just to break even. So, what exactly is this expense ratio? It's an annual fee, expressed as a percentage of your total investment, that the fund company charges to cover its operating expenses. This isn't one single fee, it's a cocktail of costs. The biggest ingredient is the management fee, which pays the salaries of the portfolio manager and their team of analysts, the people making the buy and sell decisions. Then you have administrative costs for things like record keeping, customer service, and mailing you statements. And then there's a particularly sneaky one called a 12b1 fee, which is essentially a marketing fee used to advertise the fund and pay commissions to brokers who sell it. You are literally paying the fund to convince other people to invest in it. All these costs are bundled together, and the fund automatically deducts them from your assets every single day. You never write a check for it. You never see a bill. It's just gone. A tiny slice of your money, skimmed off the top before the day's returns are even calculated. Now you might be thinking, okay, but how much can a tiny percentage really matter? Let's run the numbers, and I want you to pay close attention because this one example could be worth tens or even hundreds of thousands of dollars to you over your lifetime. Imagine two different mutual funds. We'll call them Fund A and Fund B. Both invest in the exact same types of stocks. And for the sake of our example, let's say they both achieve the same gross annual return of 8% before fees. The only difference is their cost. Fund A is a low-cost index fund. Its expense ratio is a tiny 0.1%. Fund B is a more traditional, actively managed fund. Its expense ratio is 1.1%. A 1% difference. It sounds like nothing, right? Penny on the dollar. But let's see what the destructive power of compounding fees does over time. Let's say you invest $10,000 into each fund and don't touch it for 30 years. In Fund A, your net return after that 0.1% fee is 7.9% per year. After 30 years, your initial $10,000 investment grows to approximately $99,377. Not bad at all. Now let's look at Fund B. Your net return after that 1.1% fee is only 6.9% per year. After the same 30 years, your $10,000 investment grows to just $73,568. Let me repeat that. The exact same investment with the exact same performance, but because of a 1% difference in fees, you have over $25,800 less in your account. That's more than 2.5 times your original investment, completely vaporized by fees. Didn't go to you. It didn't get lost in the market. It went straight into the pockets of the fund company. Now, imagine you were investing $1,000 a year or $5,000 a year. That gap doesn't just grow, it explodes into a six-figure chasm. This is the tyranny of compounding fees. It's a reverse miracle that punishes you for being a long-term investor in a high-cost fund. So the first rule of fighting for your financial future is to obsess over the expense ratio. For a broad market index fund, you should be looking for expense ratios well under 0.1%. For more specialized funds, you will pay more. But anything approaching 1% should set off major alarm bells. But the expense ratio, as devastating as it is not the only cost you need to watch out for. There are other traps. The next one is called a sales load. This is a fancy term for a sales commission. It's a fee you pay either when you buy or sell the fund. Some funds, known as A-share funds, charge a front-end load. This means if you want to invest $10,000 and the fund has a 5% front-end load, they immediately take $500 right off the top as a commission. Your investment on day one is only $9,500. You are literally starting the race 50 yards behind the starting line. Other funds, called B-share funds, have a back-end load or a contingent deferred sales charge. This means you don't pay to get in, but you pay to get out. If you sell within a certain number of years, say 5 or 6, they'll hit you with a commission. It usually declines the longer you hold it, but it's a penalty for accessing your own money. Then there are C-share funds, which often have no front-end or back-end load, but they make up for it with sky-high annual expense ratios, often including the maximum 1% 12b1 fee. They're designed for short-term holds, and they are almost never a good deal for the long-term investor. The solution to all of this? It's simple. You should almost exclusively be looking for no-load funds. These funds have no sales commission to buy or sell. In today's world, with so many incredible low-cost, no-load options available from major brokerage firms, there is absolutely no reason to ever pay a sales load. Paying a load doesn't get you better performance. It doesn't get you a secret advantage. It just makes your broker richer at your expense. Finally, there's one more cost, and this one is truly hidden. It's not in the expense ratio. It's not a sales load. It's the cost of trading within the fund itself. This is measured by a metric called the turnover rate. The turnover rate tells you how often the fund manager is buying and selling securities inside the portfolio. A turnover rate of 100% means that, on average, the manager has replaced every single holding in the fund within the past year. A rate of 20% means they've held on to most of their positions. Why does this matter? Because every time the manager buys or sells a stock, the fund incurs transaction costs, brokerage commissions, bid-ask spreads. These costs are not included in the expense ratio. Instead, they are paid for directly out of the fund's assets, which directly reduces your return. A fund with a very high turnover rate is like a taxi driver who is constantly changing lanes and taking detours in heavy traffic. Creates a lot of activity, burns a lot of gas, and creates a lot of friction, but it doesn't necessarily get you to your destination any faster. In fact, it often slows you down. A high turnover rate can be a massive hidden drag on performance. You might see a fund with a reasonable-looking expense ratio of, say, 0.7%, but if it has a 150% turnover rate, the real all-in cost to you could be well over 1% or even higher. Conversely, a simple index fund might have a turnover rate of just 3 or 4%, meaning its trading costs are practically zero. So when you're analyzing a fund, look at the expense ratio first. Make sure it's brutally low. Second, ensure it's a no-load fund. Don't pay to play. And third, glance at the turnover rate. If it's excessively high, you need to understand that the fund's true cost is higher than what's advertised. These costs are the single greatest hurdle between you and your financial goals. But here's the beautiful part. Unlike the unpredictable swings of the stock market, costs are one of the few things in investing that you have complete and total control over. You get to choose how much you pay. Choosing the low-cost path is the closest thing to a free lunch you will ever find in the world of finance. Because once you've minimized the drag of costs, the next critical question becomes, who is actually flying the plane? It's a question that cuts to the very heart of active management. Because unlike a passive index fund, which is on autopilot, an actively managed mutual fund has a human being, or a team of them, making daily decisions about your money. They decide when to buy, when to sell, and when to hold. Their judgment, their philosophy, and their discipline are the engine that will either power your portfolio to new heights or leave it sputtering on the tarmac. For decades, the answer seemed simple. Find a genius. Find a star manager. This was the era of legends, of managers whose names were as famous as the funds they ran. The quintessential example is Peter Lynch. From 1977 to 1990, he ran the Fidelity Magellan Fund and delivered an almost unbelievable average annual return of 29.2%. He turned a small, obscure fund into the largest in the world, and in the process, made his investors fantastically wealthy. People didn't just invest in Magellan, they invested in Peter Lynch. They believed in his "by what you know" philosophy, his tireless work ethic, and his almost supernatural ability to find 10-baggers, stocks that would go up 10 times in value. Then there was Bill Miller at Legg Mason. He famously beat the S&P 500 for 15 consecutive years, from 1991 through 2005. It was an unprecedented streak that landed him on the cover of magazines and made him a household name in the investment world. Again, investors flocked to him, believing he had a Midas touch, a unique insight into value that no one else possessed. The allure of the star manager is powerful. It's a compelling story. It simplifies the complex world of investing into a single heroic narrative. Find the right person, give them your money, and let them work their magic. It feels like betting on Michael Jordan in his prime or Tom Brady in the fourth quarter. But here's the uncomfortable truth that the marketing departments don't want you to hear. Chasing star managers is a dangerous game. It often ends in disappointment. Why? First, and most obviously, the star can leave. When Peter Lynch retired in 1990 at the age of 46, Magellan was never the same. An army of managers tried to fill his shoes, but the magic was gone. The track record belonged to Lynch, not to the fund itself. When you invest in a star, you're not just buying a portfolio of stocks, you're buying that person's talent. And that talent can walk out the door at any moment, leaving you holding a fund that is a mere shadow of its former self. Second, success can become the enemy. As a fund's assets swell into the tens or hundreds of billions of dollars, the manager's job changes dramatically. This is a phenomenon known as asset bloat. The brilliant stock picker who made their name finding small, undiscovered companies can no longer invest in them. A $100 million position in a small cap stock would be a rounding error for a $100 billion fund, and trying to buy more would send the stock price soaring, ruining the value. The manager is forced to hunt among the largest, most well-known companies, the very same ones everyone else is analyzing. Their unique edge disappears. They become a victim of their own success, and their performance often reverts to average or worse. So, if chasing yesterday's hero is a flawed strategy, how do we analyze the human element intelligently? We do it by turning away from the magazine covers and focusing on a few key objective metrics. The first, and arguably most important, is manager tenure. This is simply how long the current manager has been running the fund. Why does this matter so much? Because a fund's track record is only relevant if the person who generated it is still in charge. Imagine you're looking at a fund with a spectacular 15-year return history. It looks like a sure winner. But then you dig a little deeper and discover the manager who produced those returns retired 6 months ago, and a new and proven manager just took over. Suddenly, that 15-year track record is completely meaningless. It's historical fiction. It tells you nothing about how the fund is likely to perform in the future. You want to see a manager who has been at the helm for a significant period, ideally 10 years or more. You want them to have navigated different market cycles, not just a raging bull market. You want to know that the performance you're analyzing is their performance. A long tenure demonstrates stability, commitment, and a track record that is actually attributable to the person making the decisions today. Next, you need to look at the management team structure. Is it a lone wolf, a dynamic duo, or a committee? There are pros and cons to each. A single manager can be nimble, decisive, and can implement their vision without compromise. The fund becomes a pure expression of their investment philosophy. The downside is what's known as key person risk. If that one manager gets sick, leaves, or simply loses their touch, the entire strategy can fall apart. A co-manager or small team structure can mitigate this risk. It allows for a diversity of opinion, a sounding board for ideas, and provides continuity if one person departs. The best teams often feature managers with complementary skills. Perhaps one is a brilliant qualitative analyst, while the other is a quantitative wizard. The risk here is potential conflict or a dilution of the core strategy if the managers don't share a unified vision. Finally, you have funds run by a large committee. This is common at massive investment firms. The benefit is immense resources and stability. The departure of one or two analysts is unlikely to derail the entire process. The major drawback, however, is the risk of groupthink. Committees can become bureaucratic, slow to react, and may end up producing a portfolio that looks suspiciously like the index they're trying to beat, just with higher fees. They can be designed to avoid mistakes, rather than to generate exceptional returns. Once you understand who is running the fund and for how long, you must analyze their investment philosophy and process. This is the how. How do they see the world? What is their repeatable process for picking investments? You should be able to understand and explain it simply. Are they deep value investors searching for cigar butts like Warren Buffett in his early days? Are they growth investors looking for the next Amazon or Google? Do they use a quantitative screen to filter thousands of stocks? Or do they perform deep bottoms-up research on just a few dozen companies a year? This information is not a secret. It's laid out in the fund's prospectus and in the manager's letters to shareholders, which are found in the annual and semi-annual reports. Reading these letters is one of the most valuable things you can do. Does the manager write with clarity and intellectual honesty? Do they admit their mistakes and explain what they learned? Or do they fill the page with jargon and blame the market for any underperformance? A manager who can communicate their strategy clearly and honestly is a manager who has a clear and honest strategy to begin with. Their philosophy also needs to align with yours. If you're a conservative, long-term investor, you probably don't want a manager making big, concentrated bets on volatile biotech startups. Consistency between what they say they do and what they actually own in the portfolio is paramount. Finally, there is one metric that cuts through all the noise. It's a powerful indicator of a manager's conviction in their own strategy. Skin in the game. How much of their own money does the fund manager have invested in the fund, right alongside the shareholders? Think about it. If the person in charge of your money isn't willing to eat their own cooking, why should you be? When a manager has a significant portion of their own net worth in the fund, their interests are perfectly aligned with yours. They feel the pain of downturns more acutely, and they celebrate the victories more personally. It's the ultimate vote of confidence. This information is a required disclosure by the SEC and can be found in a document called the Statement of Additional Information. Finding a manager with a seven-figure investment in their own fund tells you they aren't just managing a product. They are stewarding their own capital and believe deeply in the process they've created. Analyzing the pilot of your mutual fund isn't about finding a celebrity. It's about finding a seasoned professional with a long, proven track record, a clear and consistent philosophy you understand, and a personal stake in the outcome. But even the most experienced pilot with the best philosophy is ultimately judged by one thing: their results. And to truly understand those results, we need to look beyond the simple return number and dive into the sophisticated metrics that separate luck from true, repeatable skill. And the first tool in our skill detection toolkit is the concept of risk-adjusted returns. This is a game-changing idea, and once you grasp it, you'll never look at a fund's performance the same way again. See, anyone can generate a high return by taking a reckless amount of risk. It's like a driver bragging about getting from New York to Los Angeles in 30 hours. Your first question shouldn't be, wow, how? It should be, how fast were you going? How many laws did you break? How many times did you almost crash? The journey matters just as much as the destination. In investing, the journey is the risk, and the destination is the return. Risk-adjusted metrics tell us who the skilled, professional drivers are, and who's just a teenager with a lead foot and a lucky streak. The granddaddy of all these metrics is the Sharpe ratio. If you only learn one, make it this one. The Sharpe ratio answers a beautifully simple question. For every unit of risk I took, how much return did I get back? It measures the reward per unit of risk. Think of two funds. Fund A returned 20% last year. Fund B returned 15%. On the surface, Fund A is the clear winner. But then you look at the journey. Fund A's value was a violent roller coaster, swinging up 30%, then down 25%, then back up again. It was a white-knuckle ride. Fund B, on the other hand, was a smooth, steady climb. It had very few down months and just chugged along. The Sharpe ratio quantifies this difference. It takes the fund's return, subtracts the return you could have gotten for zero risk, like from a US Treasury bill, and then divides that by the fund's volatility, which is measured by something called standard deviation. You don't need to do the math yourself. Every major financial website calculates it for you. All you need to know is this: the higher the Sharpe ratio, the better. A Sharpe ratio of 1 or higher is considered good. 2 is very good, and 3 is exceptional. So, when we run the numbers, we might find that Fund A, our 20% gainer, has a Sharpe ratio of 0.8 because its volatility was so terrifyingly high. But Fund B, our steady 15% gainer, might have a Sharpe ratio of 1.5. Suddenly, the picture is flipped. The manager of Fund B demonstrated far more skill. They delivered a strong return without giving their investors a heart attack. They were the professional driver, not the reckless teenager. Looking at the Sharpe ratio forces you to stop chasing the highest number on the page and start asking the smarter question. Who is generating the best performance for the amount of risk they're putting my capital through? But the Sharpe ratio has a tiny flaw. It's a bit of a nervous passenger. Penalizes all volatility equally. It sees a big swing up and a big swing down and calls them both risk. But as an investor, do you really mind if your fund shoots up by 10% in a single month? Of course not. That's not risk. That's a pleasant surprise. The only volatility you truly care about is the bad kind, the downside volatility that makes your stomach drop. This is where our second metric, the Sortino ratio, comes in. It's like a smarter, more refined version of the Sharpe ratio. It asks a slightly different and arguably better question. For every unit of bad risk I took, how much return did I get? It completely ignores the good volatility, those happy upward spikes, and focuses only on the harmful downside deviation. It measures a manager's ability to generate returns while protecting you from the painful losses. Let's go back to our drivers. The Sharpe ratio would penalize a driver for finding a clever, safe shortcut that got them to their destination an hour early. It just sees a deviation from the expected path and calls it risk. The Sortino ratio is smarter. It doesn't care about the good surprises. It only cares about the times the driver swerved, ran a red light, or almost hit something. It focuses exclusively on the negative, dangerous risks. So when you're comparing two funds that seem similar, the Sortino ratio can be the tiebreaker. If both funds have a good Sharpe ratio but one has a significantly higher Sortino ratio, it tells you that manager is exceptionally good at protecting capital. They deliver the goods without the gut-wrenching drops. In a choppy or declining market, that's the manager you want in your corner. They're not just good on offense, they're a master of defense. Now let's add another layer of sophistication. We've talked about total volatility, but not all risk is created equal. There are two fundamental types. The first is risk that's specific to a single company, a CEO scandal, a failed drug trial, a factory fire. This is called unsystematic risk, and it can be almost entirely eliminated by owning a diversified portfolio of many stocks, which is exactly what a mutual fund does. The second type of risk is the one you can't escape: market risk. This is the risk of the entire economy hitting a recession, or the Federal Reserve raising interest rates, or a global crisis. This is called systematic risk, and no amount of diversification can make it go away. To measure a fund's exposure to this unavoidable market risk, we use a metric called beta. Beta tells you how sensitive a fund is to the movements of the overall market, typically the S&P 500. The market itself has a beta of 1.0. A fund with a beta of 1.0 will, on average, move in lockstep with the market. If the market goes up 10%, the fund goes up about 10%. A fund with a beta of 1.2 is 20% more volatile than the market. It's like a sports car. It'll go faster in a bull market, but will likely crash harder in a bear market. A fund with a beta of 0.8 is 20% less volatile. It's a steady sedan, offering a smoother ride but perhaps lagging a bit when the market is roaring. Why does this matter? Because it leads us to our third key metric, the Trainer ratio. The Trainer ratio is a cousin of the Sharpe ratio, But instead of dividing a fund's excess return by its total volatility, it divides it by its beta. It asks a very specific question. How much return did you generate for each unit of market risk you took on? This is critical. It helps you see if a manager is actually a genius, or if they're just getting great returns by loading up on high beta stocks and riding a market wave. Any manager can produce high returns in a bull market by buying the riskiest stocks. That doesn't take skill, it just takes nerve. The trainer ratio helps us strip that away and see who is generating returns efficiently, without simply cranking up the market risk dial to 11. This brings us to the Holy Grail, the one metric that, more than any other, attempts to measure pure, unadulterated manager skill. It's called alpha. Alpha is the magic ingredient. It's the secret sauce. It represents the portion of a fund's return that can't be explained by the market's movement. It's the value that the manager, through their brilliant research, their savvy trading, and their disciplined process, has added on top of what the market gave them. Here's the simplest way to think about it. Based on a fund's beta, we can calculate its expected return. If a fund has a beta of 1.2 and the market returns 10%, we would expect that fund to return about 12%. But what if it actually returns 14%? That extra 2%? That's alpha. That is the manager proving their worth. They beat their benchmark not by taking on more risk, but through superior skill. A positive alpha means the manager is adding value. A negative alpha means the manager is actually destroying value. You would have been better off in a simple cheap index fund after accounting for the risk they took. When you look at a fund's fact sheet, alpha is the ultimate report card. It answers the most important question for any active fund. Is this manager worth the fees I am paying them? If the alpha is consistently positive, the answer is yes. They are earning their keep by delivering returns above and beyond what you could get from the market itself. But if the alpha is 0 or negative, you have to ask yourself a hard question. What am I paying for? You're paying for a manager who is either just mimicking the market or, even worse, underperforming it. These four metrics, Sharpe, Sortino, Trainer, and Alpha, form a powerful quantitative toolkit. They allow you to look under the hood of a mutual fund's performance. They move you beyond the headline return number and help you dissect the quality of that return. They help you distinguish between the lucky gambler and the skilled professional, the reckless driver and the disciplined pilot. They are the X-ray goggles that let you see the true story of a fund's past. But even with this powerful quantitative toolkit, numbers can still lie. There are hidden traps and qualitative factors that can turn a high alpha fund into a ticking time bomb. And that's exactly what we'll uncover next. So you've run the numbers. You've calculated the alpha, you've scrutinized the Sharpe ratio, and you've dissected the standard deviation. You feel like a Wall Street quant, armed with a spreadsheet that tells the future. But here's the terrifying truth. The numbers are a rearview mirror. They tell you about the road a fund has traveled, but they say nothing about the washed-out bridge or the cliffside hairpin turn that lies just ahead. Relying solely on past performance is like driving at 80 miles an hour, at night with no headlights, staring only at the fading taillights behind you. The most brilliant quantitative analysis in the world can be rendered completely useless by one simple human event: a retirement party. Let's talk about the legendary Magellan Fund. Under manager Peter Lynch from 1977 to 1990, it was an absolute juggernaut, delivering an astonishing average annual return of over 29%. If you had put $10,000 into that fund, you'd have walked away with over $250,000. People who analyzed the data saw a fund that could do no wrong. The alpha was stratospheric. The track record was a thing of beauty. But then in 1990, Peter Lynch retired. What happened next? The fund's performance, to put it mildly, became mortal. It was still a massive fund, but the magic was gone. The numbers, the beautiful, perfect, historical numbers, belonged to a ghost. They belonged to a captain who was no longer steering the ship. This is the first and most critical qualitative check you must make. Who is the manager? And more importantly, how long have they been there? When you look at a fund's 10-year track record, you have to ask, was the current manager responsible for all 10 of those years? Or did they just take the wheel last Tuesday? If the star manager who generated that incredible alpha left 6 months ago, you are not investing in their track record. You are investing in their replacement's hope and a prayer. It's like buying a ticket to see a concert by the Beatles in 1985. The name is the same, but the band is very, very different. Look for a manager with a long tenure, ideally one who has steered the fund through at least one full market cycle, both a bull market and a bear market. You want to see how they behave when everyone is euphoric and greedy, but more importantly, You want to see how they react when the sky is falling and fear is paralyzing the market. Did they panic sell at the bottom in 2008? Or did they stick to their discipline and buy incredible companies at a discount? The manager's tenure isn't just a number. It's a transcript of their character under pressure. Next, you need to understand the command structure. Are you investing in a fund run by a single celebrity star manager? Or is it a team-managed approach? The star manager system can produce incredible results. They can be visionary, nimble, and decisive. But they also represent what we call key person risk. What happens if that one person gets sick, gets a better offer from a rival firm, or simply decides to retire to a private island? The entire strategy, the fund's very DNA, walks out the door with them. A team-based approach, on the other hand, is like a deep bench in sports. It provides stability and continuity. If one analyst leaves, there are others trained in the same philosophy to take their place. The institutional knowledge remains. It might be less glamorous, but it's often a safer, more durable model. There is no right or wrong answer here, but you need to know what you're buying. Are you betting on a single virtuoso soloist, or are you investing in the entire orchestra? This leads us to the next hidden trap, a problem that ironically stems from massive success: asset bloat. Imagine a brilliant chef who opens a small 10-seat restaurant. They can source the rarest ingredients, give every dish personal attention, and create culinary magic. The restaurant becomes a massive hit. To meet demand, they expand to a 300-seat dining hall. Can that chef still source the same rare, high-quality ingredients in such massive quantities? Can they still give every single plate their personal magical touch? Of course not. The quality inevitably suffers. A mutual fund is the exact same. A small, nimble fund with, say, $100 million in assets can be a speedboat. It can dart in and out of small, undiscovered companies with massive growth potential. The manager can buy a significant position without affecting the stock's price. But what happens when that fund is wildly successful and assets swell to $50 billion? It's no longer a speedboat, it's a supertanker. That $50 billion supertanker can't invest in small, nimble companies anymore. A meaningful position would require buying the entire company. And the very act of buying large blocks of shares drives the price up, and selling drives it down, a phenomenon known as market impact cost. So, the manager is forced to invest in giant megacap companies like Apple or Microsoft, the same companies every other supertanker fund is forced to buy. Their ability to find unique, undiscovered opportunities shrinks dramatically. Their universe of potential investments gets smaller and smaller as their assets get bigger and bigger. The fund becomes a victim of its own success, and its ability to generate future alpha is crippled. This is asset bloat. Always check the fund's size and its asset growth over time. A fund that has quintupled in size in 2 years might be a warning sign that the party is about to be over. Then there's the fund's personality, which you can find by looking at its turnover ratio. This metric tells you how often the manager is buying and selling securities. A turnover ratio of 100% means the manager, on average, replaces the entire portfolio once a year. A ratio of 20% means they hold on to stocks for about 5 years. A high turnover isn't necessarily bad. Some strategies depend on it, but it tells you a lot. A high turnover manager is a trader. A low turnover manager is a long-term investor. High turnover also has consequences. It racks up trading commissions, which act like a hidden fee, eating away at your returns. And in a taxable brokerage account, every time the manager sells a stock for a profit, it generates a capital gains distribution that you, the investor, have to pay taxes on, even if you never sold a single share of the fund yourself. You need to ask if the turnover ratio aligns with the fund's stated philosophy. If a manager claims to be a long-term buy-and-hold value investor in the mold of Warren Buffett, but their fund has a 150% turnover ratio, something is wrong. Their actions don't match their words. It's a red flag for a lack of discipline, or what's known as style drift, chasing hot trends instead of sticking to a core, time-tested strategy. Finally, you have to zoom out and investigate the family. The fund family, that is. Who is the parent company behind the fund? Are you dealing with a company like Vanguard or T. Rowe Price, which have long-standing reputations for being good stewards of investor capital? Or is it a firm with a history of scandals, aggressive sales tactics, or putting their own profits ahead of their investors' interests? A company's culture matters. It influences everything from the fees they charge to the pressure they put on their managers to take on excessive risk. A quick search for the fund family's name plus words like scandal or lawsuit is a crucial 10-second due diligence step that almost no one takes. So you see, the numbers tell you what happened. The qualitative factors, the manager, the strategy, the fund size, and its parent company, tell you why it happened and, more importantly, whether it's likely to happen again. Ignoring them is like hiring a brilliant employee based on a perfect resume without ever conducting an interview or checking a single reference. You've now done the deep dive. You've vetted the manager, you've kicked the tires on the fund's strategy, and you've confirmed the numbers tell a consistent, compelling story. You've found your champion funds, the needles in the haystack. But the single biggest mistake, the one that can sabotage all of this painstaking work, happens in the very next step. It's not about which funds you pick. It's about how you put them together. It's about how you put them together. This is where the dream of financial independence so often dies. Not with a bang, but with a quiet, redundant whimper. You can do all the research, you can run all the numbers, you can find the 5-star gold-rated manager of the decade funds, and still build a portfolio that's destined to fail. Why? Because most people don't build a portfolio. They build a collection. A collection of top performers that all do the exact same thing. It's like trying to build a championship football team by signing 5-star quarterbacks. You might have the best players on paper, but on the field it's a disaster. They'll be tripping over each other, all trying to do the same job with no one to block, no one to catch the ball, and absolutely no defense. This is the grand illusion of diversification. You look at your statement and you see 5, maybe 10 different mutual fund names. You feel safe. You feel diversified. But when you pop the hood and look inside, you discover that all 5 of your all-star funds own Apple, Microsoft, Amazon, Nvidia, and Google. You haven't built a team. You've built a fan club for the same 5 companies. You don't have a diversified portfolio. You have a portfolio of one idea. And when that one idea, like large-cap US tech stocks, goes out of favor, your entire portfolio goes down in flames together. All your hard work, all that analysis becomes meaningless. So how do we avoid this? We stop thinking like a collector and start thinking like a general manager. Our job isn't to acquire the most famous players. It's to build a team, a cohesive unit where every player has a distinct role, a specific job to do. Some players are there to score points. Others are there to protect. Some are fast and agile. Others are slow and steady. Together, they create a powerful, resilient machine that can win in any environment. Let's build that team right now. First, we need our offense. These are the players designed to score, to drive growth in our portfolio. This is primarily your stock or equity allocation. But even on offense, you don't just want quarterbacks. You need a mix of positions. Your first offensive player might be a large-cap US equity fund. This is your star quarterback. It's your Tom Brady or Patrick Mahomes. These are the big, reliable blue-chip companies that form the core of your growth engine. This fund will likely own the household names you know and love. It's a crucial position, the leader of the team. But a quarterback can't win the game alone. So, your next draft pick should be a player with a different skill set. Let's add a small-cap fund. This is your speedy wide receiver or your shifty running back. These are smaller, more nimble companies with the potential for explosive growth. They're more volatile, sure. They might drop the ball sometimes, but they have the potential to take a small gain and turn it into a massive game-changing touchdown. A portfolio without small caps is an offense that can only grind out 4 yards at a time. It lacks that explosive breakaway potential. Now look at your team. You have a quarterback and a receiver, but they're both growth-oriented players. What happens when the market shifts and flashy growth stocks are out of favor? You need a different kind of strength. You need an offensive line. This is your value fund. These are the unsung heroes of the portfolio. They're not flashy. They invest in solid, maybe even boring companies that are trading for less than they're worth. They don't get the headlines, but they are the bedrock of a stable offense. When the market gets turbulent and panicky, it's often these value stocks that hold the line, protecting your portfolio from catastrophic losses. A team with no value component is a team that's all flash and no substance. So far, our team is looking very American, but we're playing a global game. To ignore the rest of the world is like a football team refusing to play away games. That's why your next pick is an international fund. This player brings a completely different playbook, a different style of play from economies that move to a different rhythm than the US. Sometimes the US market is in a slump while Europe or Asia is booming. Having an international fund on your team means you're not dependent on a single country's economy to win. It's a powerful diversification tool that most American investors tragically overlook. Okay, your offense is set. You have a quarterback, a receiver, an offensive line, and an international star. You're ready to score points. But games aren't won on offense alone. You need a defense. This is the part of your portfolio that most people get wrong, or worse, they ignore it completely until it's too late. The job of the defense is not to score massive points. Its job is to protect your lead. Its job is to get on the field and stop the bleeding when your offense is having a bad day. Your defensive captain is a bond fund. Let's be clear, bond funds are boring. They will almost never be your top performer. And that's the point. They're not supposed to be. Bonds have a special, almost magical property. They are often non-correlated, or even inversely correlated with stocks. That's a fancy way of saying when stocks go down, bonds often go up, or at least hold their value. During a stock market crash, when fear is rampant, investors pull their money out of risky stocks and pile into the perceived safety of bonds. This flood of money pushes bond prices up. So, while your offense is getting hammered, your defense is on the field, holding strong, preserving your capital. A portfolio without a defensive bond allocation is like a team that goes for it on every fourth down. It's exciting when it works, but it's a recipe for blowing a lead and losing the game. And just like on offense, your defense can have different players. You can have U.S. government bond funds, which are like the ultimate safety, the goal line stand. You can have corporate bond funds, which offer a bit more yield, a bit more return, but with slightly more risk. The key is that they play a different game than your stocks. You can even add some special teams to your roster. Think about a real estate fund or a REIT. Real estate often moves to its own beat, driven by rental income and property values, not just corporate profits. It can provide inflation protection and income, acting as another diversifier that behaves differently from both stocks and bonds. Now step back and look at what we've built. We haven't just collected a bunch of funds that Morningstar gave 5 stars to. We've built a team. We have large caps and small caps. We have growth and value. We have US and international. We have stocks and bonds. We have players designed for offense and players designed for defense. When the market favors high-flying growth, our quarterback and receiver are scoring touchdowns. When the market turns and favors slow, steady companies, our offensive line is clearing the way. And when the market crashes and everyone is panicking, our defense is on the field, protecting our hard-earned gains. This structure, this allocation across different non-correlated assets, is the single most important decision you will make as an investor. It will have a greater impact on your long-term returns than your ability to pick the number one fund in any single category. Your specific asset allocation, whether you're 80% offense and 20% defense or 60-40, is your personal game plan. It depends entirely on your situation, your age, your tolerance for risk, and how long you have until retirement. A 25-year-old can afford to have a very aggressive, offense-heavy team. A 65-year-old needs a much stronger defense. But here's the final piece of the puzzle, the thing that separates the amateurs from the pros. You've assembled your all-star team. You've written the perfect game plan. You've put the best players in the world on the field in the exact right positions. But the game isn't a single play. It's 4 long quarters, full of ups and downs, momentum shifts, and unexpected events. Even the greatest teams can lose if they don't have a strategy for halftime. And in investing, halftime comes every single year. And how you manage that moment, how you adjust your team on the fly, is the final secret to long-term victory. Most people get it disastrously wrong. They get it wrong because they treat the annual review like checking the scoreboard at the end of the game. They look at the one-year return, see who won, and then bet all their money on that team to win again next year. This is the single most destructive mistake in investing. It's like trying to drive a car by looking only in the rearview mirror. You're celebrating a road you've already traveled, completely blind to the cliff that's right in front of you. The true halftime analysis, the kind the pros do, isn't about celebrating last year's victory. It's about figuring out why you won, and whether you have the right game plan to win again in the next season. This is the final and most crucial piece of the puzzle. It's not a single metric. It's a disciplined process, a championship process, and it has 4 distinct steps. Step 1, you review the game tape, not just the final score. You have to look past the one-year return number. Let's say you own 2 funds. Fund A returned 15% and Fund B returned 12%. The amateur investor says, "Great, Fund A is the winner. Maybe I should sell Fund B and buy more of A." The pro asks, "How did they get those numbers?" You pull up the metrics we've spent this entire series learning. You look at Fund A and see its benchmark index only returned 10%. So Fund A generated 5% of alpha. The manager earned their keep. But then you look at its beta. It was 1.5. This means it took on 50% more risk than the market to get that return. Now you look at Fund B. It returned 12%, but its benchmark only returned 7%. So it also generated 5% of alpha. But its beta was 1.0. It achieved the exact same level of outperformance with far less risk. Suddenly, Fund B looks like the more skillful manager. You check the Sharpe ratios and sure enough, Fund B has a much higher number. It delivered a smoother, more efficient ride. This is reviewing the game tape. You're not just looking at points on the board. You're analyzing the quality of the plays. You're asking, did the fund stick to its investment style? Or did a large cap value fund get lucky because it bought a bunch of tech stocks that went on a tear? That's style drift, and it's a sign of a manager who got lucky, not one who is good. You're confirming that the fund is still the player you hired it to be. Step 2. Check the roster for any changes. This is non-negotiable. Is the same fund manager, the same head coach who you entrusted with your money, still running the team? A star manager leaving a fund is the equivalent of Tom Brady leaving the Patriots. The team name is the same, the uniform is the same, but the person responsible for the winning strategy is gone. You cannot assume the new guy can replicate the old success. In fact, you should assume they can't until they prove otherwise. A manager change is a massive red flag that requires you to reevaluate the fund from scratch, as if it were a brand new investment. You also need to read the fund's latest shareholder report. Has the overall strategy of the firm changed? Has the fund grown so massive in assets that it can no longer operate nimbly like it used to? A small, agile fund that becomes a multi-billion-dollar behemoth is a different animal. Its best days of outperformance might be behind it. You're making sure the team you invested in is the same team that's on the field today. Step 3. Analyze the league and the playing conditions. You have to look up from your own team and see what's happening in the broader market. The strategy that worked last year might be heading directly into a headwind. Was last year a fantastic year for high-growth tech stocks? Your growth fund probably looks like a genius. But if interest rates are rising and the economy is shifting, the market environment might be about to favor slower, more stable value companies. This doesn't mean you immediately sell your growth fund, but it does mean you need to be aware of the context. Your goal is to own funds that can perform well in different economic seasons. If your entire portfolio is built to win only when the sun is shining, you're going to get destroyed when it starts to rain. This is about ensuring your portfolio is balanced, that you have players who can excel on offense and players who can hold the line on defense. You're not trying to predict the future. You're trying to prepare for it. And that brings us to the final step, Step 4. Scout new talent but have an incredibly high bar for firing your current players. After you've done all this analysis, you might identify a weakness. Maybe one of your funds has genuinely underperformed its benchmark for several years, the manager has changed, and its strategy is no longer sound. Okay, it's time to make a trade. But most people do this backwards. They start by looking for the hot new fund, the rookie of the year, and then look for a reason to sell one of their old reliable veterans. This is a catastrophic error. Constantly churning your portfolio, selling one fund to buy another, is a guaranteed way to lose. Why? 2 reasons: taxes and timing. Every time you sell a fund in a regular brokerage account for a gain, you create a taxable event. You're giving a chunk of your profits to the government, money that could have been compounding for you. Second, you will inevitably mistime the market. You'll sell a fund after it's had a bad year, right before it's about to have a great one, and buy the hot fund right at its peak, just before it's about to cool off. You become your own worst enemy, systematically buying high and selling low. So here is the most powerful, most counterintuitive secret of all. The result of a professional, disciplined annual review is most often doing nothing. Your job during this halftime isn't to frantically make changes. It's to calmly and rationally reaffirm your original investment thesis. You are looking for reasons to sell, and if you can't find any powerful ones like a manager change, a strategy drift, or sustained, multi-year underperformance against its direct benchmark, then the correct move is to hold, to trust the process, to let your winners run. High-performance investing is often boring. It's the discipline to stick with a sound strategy while everyone else is chasing noise. And that's the complete system. Think about the journey we've been on. We started with a simple price tag, the expense ratio, and learned that cheap isn't always best. We moved on to the complex world of risk and reward, decoding metrics like alpha, beta, and the Sharpe ratio to understand not just if a fund won but how it won. We looked under the hood at manager tenure and turnover, realizing that the person behind the curtain is often more important than the curtain itself. We learned to use the style box to build a diversified team. not just a collection of all-stars who all play the same position. And finally, we've just put in place the championship process for managing that team year after year. You now have a complete framework that 99% of retail investors will never even know exists. They will continue to chase last year's returns. They will continue to buy high and sell low, driven by fear and greed. They will treat investing like a casino, but you won't, because you know that successful investing isn't about luck. It's not about finding a secret stock tip or a magic formula. It is about having a superior process and the discipline to follow it. The ultimate metric, the one that governs all the others, isn't a number you can find on a website. It's not alpha, it's not R-squared, it's not the expense ratio. The ultimate metric is your own behavior. Your ability to be rational when others are emotional. Your ability to be patient when others are panicking. Your ability to stick to your game plan when the noise of the market is deafening. Finding a top-performing mutual fund is one thing, but building a portfolio that will help you achieve your financial goals for decades to come? That requires you to become a top-performing investor. The pros don't have a crystal ball that shows them the future. They just have a better process for navigating it. And now so do you.